I'm back again with non-monetary exchanges, but this is question 2. And in this question, we're going to cover in more depth fair value adjustments. Let's read the question. ABC Limited exchanges equipment with XYZ Limited. ABC Limited also paid $2,500 in cash. Below are the remaining details of the exchange, and we've got ABC Limited's information and XYZ Limited's information. Be aware that if you worked for ABC Limited, you wouldn't be able to see XYZ except for the fair value of the equipment. You could probably figure that out. Similarly, if you were working for XYZ, you wouldn't know the equipment historical cost and accumulated depreciation for ABC's equipment. Be aware of that when you're reading questions. A. Prepare the journal entries required to record the exchange for both companies, assuming the exchange has commercial substance. Let's get started with ABC. Because this exchange has commercial substance, we have to use the fair value. And as always, we start with calculating what was given up. Notice we use the fair value of the asset given up, $35,000 according to the chart. The cash paid must be added in because it is part of what the company gave up in order to get the new equipment. The company therefore has to give up $37,500 worth of value. Next, we do the fair value check. Remember that a fair value check is always required because when an asset is acquired, it cannot be recognized at more than its fair value. Therefore, when the exchange is recorded, there must be a fair value checks completed every single time. First, we look at the value of what was given up, $37,500, which we just calculated. Then we compare that to the fair value of the equipment received, $41,000. The comparison shows that what we want to record the asset at, which is $37,500, is less than the fair value of the equipment received. Therefore, no fair value adjustment is necessary. We only need to make a fair value adjustment if the fair value of the equipment received is lower. We can therefore do the entry. This entry is, of course, for ABC Limited. First, we recognize the new equipment at the value of the asset given up, which we've just calculated, $37,500. We then have to get rid of the accumulated depreciation of the old equipment, $21,000. We also have to eliminate the old equipment, the original cost, $60,000. And we have to recognize that we gave up cash, $2,500. Now, in order to make this entry balance, we recognize a loss on disposal, $4,000. Can we calculate this loss on disposal mathematically? And the answer is yes. We can do it as a plug, as you just saw me do now, but we can also calculate it. In order to calculate it, we take the value of what we gave up. Wait a minute. Why am I recording $35,000 when if you look at the entry, the equipment new is $37,500? Because what I truly gave up is the fair value, $37,500, but I have to reduce it by the cash I paid, $2,500. The actual value that I had to give up was $35,000. Now I compare that to the carrying value of the old equipment, $39,000. How is that calculated? The original cost, $60,000 less accumulated depreciation, $21,000, carrying value at the date of disposal, $39,000. If I compare these two, it will determine the loss on disposal, $4,000, which is exactly the same as what I recorded in my entry. Now that we've recorded the entry for ABC Limited with commercial substance, let's move on and record it for XYZ Limited. What did XYZ Limited give up? They gave up the fair value of the old equipment. Remember, we're using fair value because it's with commercial substance. That's from the chart. We also have to take into account the cash that we received, $2,500. Why do we deduct the cash received? Because the cash received reduces the amount that we gave up. We didn't have to give up a whole $41,000 because we got $2,500, which reduced some of the value that we had to give up. Total value of what we gave up, $38,500. Now, we have to do a fair value check. Notice that we do the fair value check whether we use with commercial substance or without commercial substance. It doesn't matter. First, we look at what we gave up. That's what we just calculated. We compare it to the fair value of the equipment received, $35,000. Now you see that what we gave up is valued at more than the fair value of the asset received, which can't happened. The fair value limitation kicks in. The maximum amount that XYZ Limited can record the new equipment at is $35,000. Let's do the entry. Remember that this entry is for XYZ. First, we have to record the new equipment at its maximum value, $35,000. Then we have to record the cash received, $2,500. Next, we have to get rid of the accumulated depreciation of the old equipment, $30,000. Direct from the chart. Now get rid of the value of the old equipment, which is no longer there, $72,000. Straight from the chart. And now this entry does not balance, so we have to record a loss on disposal, $4,500. Can we calculate this loss? And the answer is yes, we can. First, we take the value given up, $37,500. But wait a minute, here we are again. We recorded it in our entry at $35,000. Why am I writing down $37,500? Because this is made up of the maximum fair value of $35,000 plus the cash we received of $2,500, $37,500. We compare that to the carrying value of the old equipment, $42,000. This is calculated as the original value, $72,000, less accumulated depreciation of $30,000, which calculates a carrying value of $42,000. Compare these two, and you calculate the loss on disposal, $4,500. We've now done the entry for with commercial substance for both XYZ Limited as well as ABC Limited. In the next video, we'll move on to without commercial substance.